Well, good evening, everybody. I know a lot of you have been here many times before, and as is traditional, it's raining. We have special arrangements to make that happen. I'm actually a little intimidated tonight, not by you, but I've got my older sister here, Professor Judith Baskin, who does this for a living. She teaches for a living, so you know, if I seem rattled, that's why. Tonight, we're going to talk about interest rates, as Scott said, and I can see that the excitement is building in the room. But actually, interest rates are one of the most important things in our economic life. For borrowers, of course, the amount that they pay on their mortgages, the size of the house that they can afford to buy, for people who finance their cars, for people who have bank debt, interest rates are very important. For most of us here, for savers and investors, the returns we earn, whether on cash or on bonds or on stocks, even on stocks, are directly tied to the level of interest rates. So it's important for us to look at the very strange and unexpected economic circumstances we find ourselves in and to try and answer two big questions. Why are interest rates so low, and what should we do about it? How are we going to live and invest in this new, strange world of very low interest rates? I'm going to talk about this in a kind of theoretical way, as is my habit, and Barry is going to get much more specific about the kinds of investments we think are most likely to succeed in 2020 and beyond. So I thought I'd tell a little parable to get the story started here. So think about a married couple, Fred and Jane. And one evening, Fred says to Jane, "You know, I'm just sitting around here doing nothing and I'm depressed." And Jane says, "When you're depressed, my level of interest goes down." Fred replies, "Well, if your interest is down, I'm going to increase my spending. Maybe buy a new set of golf clubs. That will get me moving again." Jane replies, "That may end your depression, and I'm pretty sure my interest rate will go up. But don't drink too much after golfing or you'll just get inflation." Folks, that's Keynesian economics in a nutshell. After the 2008-2009 Great Recession, governments around the world dropped their interest rates to close to zero, and they increased their spending to spur demand. The object was to get the economy moving again, stop the depression, and it worked. We have now had, at least in North America, 10 years in a row of pretty much uninterrupted growth, and as I'll show you, it hasn't been great growth, but growth nonetheless. The normal expectation is that as growth continues in the economy, interest rates go up. And that's done by central banks in order to prevent demand from getting out of hand, forcing up prices, which will result in inflation. But oddly, that's not what's happened this time around. This is the Bank of Canada rate. You don't have to look at the numbers to know what's going on here. 25 years ago, most of us in this room could walk up to any corner bank and buy a GIC that would pay 5 or 6 or even 7%, depending on the year, for the next 5 years. And that was pretty easy. You can see the Great Recession on this chart. That's where the line goes down to the bottom of the chart, and then it stays there. The Bank of Canada dropped rates from 5% to less than 1% in less than a year. But oddly enough, even though the Canadian economy grew, rates stayed below 2% from 2009 to now, and the Bank of Canada left them unchanged for the 8th time in a row today, even though they see some threats. So why are interest rates so low? Take a look at this slide. Much of the answer lies in the very slow and very anemic recovery from the recession. On this graph, there are 4 vertical gray lines. Each of them mark a recession in the past 30 years and the subsequent recoveries. And the red horizontal lines show the average level of domestic growth, of gross domestic product, in the periods between the recessions. And the thing to note here is that after each successive recession, the red line is at a lower level on the graph. After the 1981 recession, growth was about 4% per year. After 1992, 3.5%. After 2002, 3%. And after this recession, about 2.25% per year. And in fact, the numbers that came out yesterday show the U.S. economy growing at 1.9%. That's not a great level of growth. This is the weakest recovery we've had in that 30-year period, and central bankers are terrified that if they raise interest rates, they'll kill off even this mediocre level of growth. Now, I'm sure you're all aware that unemployment rates in Canada and the United States are at post-war lows, lows that probably most of us never thought we would see. Under 4% unemployment in the United States, under 6% unemployment in Canada. So you might well ask yourself, with all these people employed, why are we not getting greater growth? One of the reasons you can see in this graph here, which is the labor force participation rate. When we measure unemployment, we're measuring the number of people who would like to be working who aren't working. The labor force participation rate measures the people who could be working who aren't working. So you can see on this graph that in the United States, participation peaked out at about 67% 20 years ago in 2000. And even after this recovery that we've had, 10 years of consecutive economic growth, the current participation rate is 63%. Now that might not sound like a big difference, but in the big United States labor force, that's 8 million people who have voluntarily taken themselves out of the labor market. They're not unemployed because they're not looking for work, but they're certainly not employed. They're not adding to gross domestic product. They're not making the recovery more robust. And by the way, a similar thing is happening in Canada, although not to quite the same extent. An interesting question is, why are these 8 million people not working? What's going on here? I think that's more of a question for a sociologist than for an economist, and nobody's quite sure. There's a couple reasons I'm going to suggest. One reason is what I would call a bad match of the skills of these people who have dropped out of the labor force to the jobs that are available. I come from Hamilton, as many of you know. In Hamilton, the steel industry is a shadow of what it was when I was growing up, but I can tell you that if you're a 55-year-old unemployed steel worker in Hamilton, the new jobs at McMaster University or at the hospitals that are growing in Hamilton are probably not available to you. You simply are not going to get the skills. You're not going to be able to be retrained, and those people leave the labor force, and they leave for good. And I'm sure you've all seen pictures on the internet of coal miners in Kentucky learning how to be computer programmers, and they become unemployed computer programmers. Another possible reason is the so-called epidemic of diseases of despair. Diseases of despair, as the name suggests, alcoholism, drug addiction, obesity, and perhaps a widening discontent at the large and growing disparity between the very rich and the very poor, a phenomenon present in both North America and in the developed economies of Europe, and as we're seeing in Chile, really around the world. And in the candidacy of Bernie Sanders and Elizabeth Warren, I think we're seeing a reaction to that as well. And who knows how successful or unsuccessful that will be. Without question, the most shocking thing that's happened in the world of finance is the emergence of negative interest rates, something that nobody thought could happen. 5 years ago, if I'd been standing up here and somebody had said, do you think interest rates could ever go below zero? In other words, do you think you would have to pay to put your money in a bank instead of having the bank pay you? I would have said, no. Economic orthodoxy says that's impossible, could never happen. Well, boy, was I ever wrong. If you look at the graph on the far left, you can see red dots. There's 13 countries on that graph. Each red dot reflects a negative yield on a bond of varying maturities. The graph on the left is 1 year ago. The graph in the middle is now. You can see those red dots have spread kind of like measles. And there's now negative yields out to 30 years. The graph on the right says that there's now 14 trillion, not billion, but trillion dollars worth of bonds that have negative interest rates. $14 trillion is a lot of money, folks. That's 7 times the gross domestic product of Canada. And there's $14 trillion of money getting a negative yield on their investment. Now, like the Bank of Canada, the Federal Reserve Bank in the United States has been keeping interest rates very low. Today, the U.S. Federal Reserve dropped its interest rate another half a point. Not surprisingly, in light of the negative interest rates in Europe and Japan, a lot of money has flooded into the United States. And one of the reasons rates have gone down in the United States is because the U.S. dollar has gotten so strong as money has flooded in from overseas. This makes it harder for U.S. companies to export. It makes it easier for foreign countries to sell goods into the United States. And this is one of the reasons that Donald Trump has been hammering the Fed to keep interest rates lower and lower and lower, even though the economy is still growing. I suppose that everybody thinks that things are going to stay the way they are. We're going to think that whatever conditions were like when we grew up are how they're going to be in the future. But in fact, that's not the case. This is a graph of the expected economic growth in many of the world's leading economies compared to the growth over the last 50 years. The red lines on the right show you the decrease in growth from one period to the next. On the top is Saudi Arabia, which is going to see a decrease in economic growth of 73%. That's because oil is going to be supplanted in the world economy by other sources of energy. But as you go down the list, you'll see that basically every industrialized country in the world, Mexico, Brazil, Canada, Germany, South Korea, is going to have lower growth in the next 50 years than it had in the last 50 years. So if you think about your 20-year-old self and what you experienced as you grew into adulthood and what your 20-year-old children or grandchildren are likely to experience, it's a different world. So why is that? And what does this have to do with interest rates? This is a graph of the change in world population. It's a very interesting graph. Around 200 years ago, the population of the world hit 1 billion for the first time, 1 billion people. And it took 124 years to double to 2 billion people. And you can see the length of the graph shows you the length of time it takes for the population to increase by 1 billion people. All of a sudden, it went from 2 billion to 3 billion people quite suddenly, and doubled to 4 billion people in only 48 years, and then doubled again to 8 billion people in another 48 years. This is a result of the healthcare revolution, lower child mortality, lower mortality in childbirth, longer life expectancy. But look what's happening at the end of this graph. All of a sudden, the time to add another billion people to the world is increasing rather than decreasing. This is a result of lower birth rates and people making decisions about how many children they want to have. And many people, of course, think that this is a very good thing indeed, that population is not going to grow forever. Now, in the 19th century, economics came to be known as the gloomy science. Why was it the gloomy science? Because the leading practitioners, guys like Malthus and Marx, said that inevitably higher population is going to lead to economic disaster. But in fact, as the population doubled and redoubled, from 1 to 2 to 4 to 8 billion, that's not what happened at all. If you look at this graph, you will see that economic growth not only met new population, but increased faster, so that people all over the world became richer than they had before. The gloomy economists were wrong. But one of the side effects of people getting richer is that education increased, and particularly education of girls and women. And one of the things that has been proven throughout the world, without exception, is that as women and girls get more education, they have fewer children. That's one of the reasons why the rate of population has slowed. And if you look at this graph, those of you who worry about overpopulation, this is for you. You can see that world population growth is going to go to 0 by the end of this century. Current projections are that the world population will peak out at around 11 billion people and then start to decline rather rapidly thereafter. These graphs have to do with the United States. The graph on the right, with the red line, shows you the fertility rate in the United States. In other words, the number of babies being born to women in childbearing age, and you can see there's a fairly precipitous decline. The one on the left shows you that the number of babies born this year will be the same number as the number of babies born in 1970, even though the US population is 60% larger than it was in 1970. The United States now has falling population absent immigration. In other words, there are more people dying than there are babies being born, and only immigration will keep it from declining quite rapidly. Slowing economic growth in both the developed and the developing worlds, coupled with and closely related to falling population growth and falling fertility rates, are two reasons for the very low interest rates that we've seen. Another reason for falling interest rates, and Barry's going to talk about this in more detail, is the change in the nature of industry. Today we had earnings from two of the biggest companies in the world, two of the most valuable companies in the world measured by market cap, Apple and Facebook. Facebook employs, I think the number was 45,000 people. Most of these people sit at desks with computers in a warehouse-type building. That's not a big user of capital. 100 years ago, a company with 45,000 people was building railways or setting up car factories or learning how to build airplanes. They were huge users of capital. The demand for money to fund those kind of companies was enormous. Not so much now. There's low demand for money. What is the price of money? Interest rates. Interest rate is nothing more than what you pay for money. If there's low demand for money, it makes a lot of sense that interest rates are low. And I want you to look at this slide because I now want to talk about the supply of money. The supply of money has grown enormously, and one of the reasons for this is the growth of gigantic pension plans. In the United States, pension plans have over $30 trillion of assets, equal to 140% of US GDP. That's an inconceivable number. It's impossible to know what that means, $30 trillion. But here's what you need to know. If you're a pension fund manager, you have to keep that money invested. The only way you're going to be able to pay your pensioners money in their retirement is if you make money for them, and you can't sit on it. So on the one hand, we have low demand for money because business simply isn't using money the way it used to. On the other hand, we have a huge supply of money because of these gigantic pools that have been formed. Now, if you're a pension plan manager, what's your time horizon? 50 years? 100 years? Somebody starts working at 22 years old and is perhaps going to work till they're 65 and then stay retired for another 30 years after that. When you're investing assets for those people, you have to take a very long view indeed. And if one of the consequences of that is that you have to put up with negative interest rates for a year or two, in the total horizon, in the total world of how long you're going to be investing money, it's not a big deal and you can put up with it. So low interest rates can persist simply because there's this huge supply of money looking for a home and it can't find a good place to go. So, that's the situation. We're probably going to be faced with low interest rates for a while. So the question is, what do we do about it? I suppose one answer could be, get over it. You used to be able to get 5% at the corner bank, now you can't. That's life, don't be a snowflake. That's the way it's going to be. But on average, we're all going to live longer than we thought. You can see here the life expectancy for Canadians, both men and women, has increased. So we're going to live a long time. We have to do something with our money. But if we just sit on our money, we know what happens. Inflation eats away at the value of our money. This is a graph showing the rate of inflation in Canada over 30 or so years. It shows you that the value of money is much less than it used to be. Here's looking at it from the other direction. $100 in 1970 is worth $18 today. If you sit on your money and do nothing with it, Because interest rates are too low, inflation is going to take away a lot of value all by itself. So you have to do something. What are we going to do with our money? Well, this graph shows you 6 things we could do with our money, and it measures them against 5 different categories. Is it risky? Is it liquid? Can we sell it if we need to? Does it have a good return? How is it treated for taxes? And how much does it cost us to make this investment? You can see that nothing's perfect. High returns are coupled with high risks, which is what you would expect. Some assets, like real estate, have high transaction costs, and they are not very liquid. They take time to sell. In Canada, we tax investments differently. Some get good tax rates, some get bad. And of course, none of this is static. Things change over time. So one of our jobs is to keep looking at the available asset categories for our clients and decide which one is the one that has the best possible return at the moment. This is a graph of the largest stock index in the United States, the S&P 500. You can see it's gone up 500% since 2000. 500%, not in a straight line, by the way. There's been bumps on the road, and you can see them. You can see the gray lines, the dot-com recession, and the Great Recession of 10 years ago. But the return over time is impressive. And this is for the broad index. Our opinion is that our clients can do better than the broad index. You don't have to own every stock to get a good return. And I'm going to give you a couple examples. In 2001, Nortel was by far the most valuable company in Canada. And at its peak, it represented 35% of the entire TSX index. If you bought the TSX index, know it or not, 35% of your money was going into one stock. You might have thought you were getting diversification, but you weren't. We all know what happened to Nortel. Those who owned the index or owned that stock directly were hurt, and some were hurt badly. Those of you who are clients in 2001, you were fine. The only time we owned Nortel was for a week or so after it got spun out from Bell Canada, then we sold it. So you didn't get hurt. A very similar story played out in the United States in the NASDAQ index, the index concentrated in high technology stocks. You can see that that index also peaked around 2001 and took a full 15 years to get back to that level. In other words, if you bought the index, if you didn't try and pick good stocks and differentiate them from bad stocks, it took 15 years to get your money back. Who can remember names like JDS Uniphase, Sun Microsystems? Those were the leading stocks 15 years ago. There was no obligation in 2000 for investors to take the crazy risks or buy into those silly valuations that dominated the index. They could have been picky. One more example. This is from the last 5 years in Canada. Everybody knows the oil and gas sector has done pretty badly in Canada the last 5 years. The dark blue line shows you the performance of the energy stocks on the Toronto Stock Exchange against the broad TSX index shown in gold. You didn't have to own any energy stocks. In fact, if you've been a client of ours for the last 5 years, you haven't owned any energy stock at all since 2014 or 15 because we went to zero weight on the sector. My point is, just because stocks are good doesn't mean that every stock is good. And just because owning stocks is a good idea doesn't mean that you have to own every stock. So, here are my 4 lessons, the 4 takeaways from what I've talked about tonight about investing in the low interest rate world. Number 1, as always, asset allocation is the most important decision made about your portfolio. Just because we take the position that cash and bonds are unimportant doesn't mean that we don't have to buy them as shock absorbers, as protectors. We have to look at things like index funds. We have to look at real estate products. We have to look at everything because things change over time. Asset allocation is paramount. A lot of people are hearing about alternative assets, and they're calling me up and saying, can we get into private equity? Can we get into mortgage funds? Can we get into this or that? Ladies and gentlemen, the alchemy the sorcery of investment has always been trying to get a higher return with less or lower risk. And just like the alchemists of the Middle Ages, can't do it. Every alternative investment comes with a cost. Some of them come with a very high cost indeed. I believe we're going to see a huge reckoning in the private equity market as a lot of people find out that what they bought, like WeWork, is perhaps not worth as much as they thought. High quality stocks stand the test of time. During the recession of 2007, 2008, we owned about 50 stocks for all of our clients put together. No one of them owned all 50, of course. But of those 50 stocks, almost everyone paid a dividend, and during the recession, I believe 3 cut their dividend. The other ones just kept paying. If you were a client who was interested in the income from your portfolio, nothing much changed during the worst recession in 70 years. The last time a bank in Canada cut its dividend was in the middle 1940s, 70 years ago. I don't think any of them are cutting their dividends. Similarly, the telephone companies, the pipelines, and the utility companies are pretty reliable and are unlikely to cut their dividends. High quality stocks stand the test of time. Our job is to find them. Finally, a lot of people are attracted to the world of exchange-traded funds because they come with lower costs, lower management fees. And certainly compared to mutual funds, they're a much better thing than owning mutual funds. But as you know, we don't really own mutual funds or exchange-traded funds except in very unusual circumstances when we want to invest in a market that we don't know very well, for example, a foreign market. Exchange-traded funds get exactly the problem that we've been talking about here. They own the good stocks, they own the bad stocks, they own the ugly stocks. When you buy the index, you get them all. You don't want them all. So, we have to resist the temptation to invest in those broad index products. That's it for me. That's the theory part of the evening. I hope you found it enlightening. Barry's a lot more fun than me. Look, you have to know your limitations. And he's going to talk about this using some real-world examples and tell you what we plan to buy for your portfolios in 2020. Thank you.